Hello everyone, welcome to module 3 part 2 of this entire financial modeling of a startup series. In this video, we are going to model P&L statement for the next 3 years. We are going to model this entirely practical on Excel and understand each and every line item assumption in detail. You can start working on this model alongside with me. Download the template from the description below. Let's move on to the screen and get started. So we are here on the presentation of module 3 part 2, where we are going to build 3 years projection of profit and loss statement. Here we are going to understand the expansion plan of Sandy's Sandwich Private Limited, which is the case study that we are using in this entire series to understand how a financial model is built for a startup. We are going to understand the expansion plan of this company, why they are creating a financial model, and after that we are going to understand what are the revenue drivers and projection. So whenever you create a financial model, it is very important to understand what are the line items which you are going to project and what are the assumptions that you are going to take behind each and every line item. After understanding the revenue drivers and projection, we go on to projecting COGS, all the operating expense that are incurred by the company that we are forecasting for, and finally we are going to project the gross profit and the EBITDA margins of the company. If you haven't checked out the first part of the module, we would recommend you to have a look to that and then start with the second part. It would be easier for you to understand the entire structure of financial model. Before we move ahead, this is the template of 3 years of P&L statement that we are going to forecast for. This is the current year's P&L statement that we had already built during the first part. Today in this video, we are going to project for the next 3 years using this revenue template, and finally we are going to project all the operating expense using this template. If you want to download this template, the link is in description. Start alongside so that you have a model ready after you complete this entire series. So let's get started with the first line item, which is expansion. So in the previous video, we understood about the company's current performance. What was its revenue, what was the COGS that it was expending, what were the operating expenses, non-operating expenses, and finally we got to net profit. But now the things are going to change. The company is now planning to expand its line of business by raising funds, and when a company raises fund, it has to create a financial model so that it can be pitched to the investors of what are the plans when the money comes into the business. So we are going to create a post funding financial model where we are going to explain each and every line item along with a storyline. Point number one is angel round of 20 lakh rupees to be raised. So here we are saying that the company is going to raise 20 lakh rupees in funding for expanding to NCR and Noida. So currently the company is based on, so currently the company has an outlet in Delhi. Now they are planning to go to NCR and Noida and open more outlet so that it can expand its line of business. Okay, so let's model how this funding will impact the next 3 years. So before moving on to projection, it is important to understand that whenever you create a financial model, you will be sitting alongside with your client for whom you are creating a financial model, and you will be then portraying a story that you will be presenting to the investors that you are pitching your model. So in this video, we have created the entire storyline by ourselves since it's a mock company that we have took. But whenever you start working, you will be sitting with your client. You have to put in your thoughts of how you are seeing the picture of the entire story of the business, and the management of the company for which you are creating model will be portraying their storyline, and then you combine it together and put it in the financial model. So for our case study, let's get started and understand the expansion plan year wise. So we will go through each and every assumption and we will put in all the assumptions in our Excel sheet to create the entire model. So we have a table in front of us which explains year wise expansion plan, what are the sales growth and what are the price changes that we are seeing in the next 3 years. So about year one, we are expanding to one more outlet. The sales growth is going to be 1.2 times of what is currently happening, and the price are going to remain same at rupees 100 for each unit. So let's put this assumption in our Excel sheet. So we are starting with revenue. So before we put in the assumptions in our sheet, we are going to understand revenue drivers and revenue projection in short. So revenue drivers will include the key performing indicators which are key determinants of a revenue. So in our example, since we are selling out sandwiches to customers, the units of sandwich sold will be a key revenue driver. If that number increases, then our revenue increases. If that number decreases, then our revenue decreases. So that is a particular revenue driver for us. So whenever you are having discussion with the management, your discussion goes on the key revenue drivers for a particular business line. So here we have expansion plan where we have seen that we are adding one outlet in year one outlet in year two, and in year three there is no new outlet. We will start with the main revenue driver, number of outlets. So currently we have one, then in year one we will be having total of two, and then in year two we will be adding one more, so we will have three, and from year three we are constant at three. So if the number of outlets increase, your revenue is definitely going to grow because you are going to reach to more customers and sell out more sandwiches. So next assumption we can see is about sales growth, where we are projecting that in year one we are going to grow 1.2 times our sales of previous year. In year two we are going to grow 1.3 times. In year four we are going to grow 1.4 times. Now about sales growth, so there are two types of assumptions you can take for sales growth. First is you are growing slow to higher rate. In some other cases you are growing higher to slower rate. So in our example, since sandwich is a product which is already in the market for so many years, to get people to customize to your taste, to make them your regular customers, you have to give some time to business, and that is why your growth in the initial phases would be bit low, and it would grow steadily when you take time, get more customers, join on a regular basis. If on the other side you are a business that is very aesthetic in nature, which is very trendy, you are selling out products which are like ongoing with trend, so your sales growth will be very high in the initial period than in the later on periods. So for such kind of businesses, your sales growth number would be reverse of what we are seeing over here. So it would be 1.4x in year one, 1.3 in year two, and more or less in year three. So for such kind of businesses, you have to continuously keep pumping money into the business so that you can expand fast and get sales coming into the business at the fast rate. Whereas on what we are modeling for, the company is slow and steady in nature because we are selling out a product which is like not time agnostic, and it is going to be in market for the next coming year. So here the growth will be slow in initial period, and then you are going to grow at a bit higher rate than what is now. So that is why we have taken 120% growth in year one, and then it goes on increasing to 140% when the initial two outlets have good amount of customers as their client base. So we will model for this sales growth on the basis of number of units that we are selling out. So when we created profit and loss statement in the previous video, only had the outlet model which gave us revenue. The food delivery app is a model that we are going to start from year one, and the entire assumptions that we saw now are related to the outlet model. In the current year we sold 10,000 units on a yearly basis, but for the month we are going to divide it by 12 so that we get a number which we sold on a monthly basis. So that is 833 sandwiches were sold monthly. As we already have assumption with us, the year one growth rate was 1.2 times of the current year, then it grew to 1.3 of the year one, and finally it grows to 1.4 times of year two. So that way we are scaling from 833 sandwiches per month to 1820 sandwiches in year three. That is around 2.2% growth rate on a total basis. So this is a key driver because we can see that the numbers of sandwiches which are sold is increasing, and this will give us increase in revenue as well. So now we come to the final assumption for the outlet model, which was about price change. So in year one we are saying that we will keep the price of sandwich around 100 rupees only, which is what is current price, and in the year two and year three we are going to increase the prices by 15%. So the thought process behind keeping prices same for year one was to get more customers joined with us and to be competitive in the market, and from year two when some of the customers are already with us, we can then increase prices to keep up with the margins and inflation. So when we make sales based on a unit, it is termed as average revenue per unit, which is also called as ARPU or ARPU. So this is a technical term which will help you when you start working. So over here we have 100 rupees current price. Then in year one we are going to keep it same 100, and in year two and three we are going to increase it by 15 percentage, and in year three also we are going to increase by. So now we have KPIs for the number of outlets that we have and how are we selling at those outlets. So next we move to revenue streams, where we can see that we have two models. First is outlet model, and then we have app based delivery. So for app based delivery we are using various applications like Zomato, Swiggy, Magic Pen, such kind of apps to deliver sandwiches to our customers. So we have already modeled for outlet services. Now we are going to model for the app based delivery. So let's read the assumption. For the outlet sales, physical sandwiches are sold. So people are coming into our outlet, buying sandwiches and having them in the outlet or taking them away. Now for the app sales. So for the app sale, it is written it is 30% of the outlet sales for year one and year two, and it increases to 35% in year three. We will now model this. So over here in the assumption, we saw that the year one and year two numbers are 30% of what is sold in the outlet. So if outlet is selling 10 sandwiches on a daily basis, on the food delivery app we are doing 3 sales, that is 30%. So we will take both this matrix and paste it over here. So currently we did not have any app based delivery going on, so we will do it 0 0. And in year one we mentioned that the number of units sold was 30% of year one outlet sale. So 1000, which is being sold in outlet in year one, and multiplied by 30 percentage. So that way we got 300 as the number of units sold on the app on a monthly basis. Year two number is also same, where we are doing 1300 sandwiches in outlet, and of that 30% is being sold in food delivery app, that is 390. And finally in year 3 we are increasing this to 35%, that is 637. So that way we got the units of sandwich sold on the food delivery app. Now we will see the assumption for pricing. So the app price is 135% of outlet price to maintain margin. So now when you are trying to expand your business through application based delivery, you have to pay additional some commission to the app on which you are selling your product. So the most popular apps like Zomato and Swiggy, they charge around 20 to 25% as their own commission when you sell on their application. So here to make some extra revenue, we have priced it at 135% of what will be the outlet price, and slowly and gradually expand more into food based delivery. So now we plug in the ARPU on the food delivery app. So we saw that it is priced at 135%. So that is 135 percentage of the price of outlet. So in year one we are going to have price of 135. In year 2 and 3 we are going to have 155 and 179. So that way you model out the entire ARPU of the food delivery application. So I am quite hands-on with the formulas of Excel and use it all on laptop. You can do it all manually, or if you are also comfortable using formulas, you are most welcome to do that. If you want us to create video on Excel, how you can create such templates, how you can use various shortcuts on keyboard, then let us know in the comments and we will create a detailed video on. For now, let's continue on to the next assumption. So now we are ready with revenue drivers which will help us to project revenue. So without moving ahead, we will first project the revenues that we will be doing in the coming 3 years. So we already have units of sandwich sold monthly basis. Now we are calculating this for the entire year. So we will need the number which we have sold for the entire year. So we will add unit sold, and finally we are going to add the average revenue per user. So we have the assumptions over here. So in revenue projection, you are multiplying all the revenue drivers with one another and calculate the entire revenue that you had earned for the year. So for the current year, we already had the number of 10 lakh as our revenue. Now through this model, let's see how we can come to that 10 lakh revenue. So number units of sandwich sold monthly, which was 833. So 833 was on a monthly basis. To calculate units sold annually, we will need to multiply this number by 12. So we took C22 as our cell, multiplied by 12, and we got 10,000 rupees. So this is not rupees, we have to convert this to. So you can go over here, you can manually select number from here, and then to give commas, you can select this comma button and then do it this way. So that way you got 10,000 units sold on the yearly basis. Now the average revenue per unit, we already have that number as 100, and now we will calculate revenue from outlet sale, which was 10,000 multiplied by 100, which is 10 lakh rupees. So that is how we got the number of 10 lakh in our P&L statement. So similarly we will do it for year 1, year 2 and year 3. So we have already plugged in the proper sales over here, and we are wanting to just scale it to year 1, year 2 and year 3. And so we will copy this entire 3 cells and paste it over here. That way we do not have to manually plug in all the numbers, and we can do it in a systematic and fast manner. So we can see that units of sandwich sold in year one already comes to 1000. Then in year two we are at 1300, and so 1300 is plugged in from up. And we also got the number of sandwiches sold on annual basis, where each of the cell is multiplied by 12. And that also we have the ARPU for each unit of sandwich sold. Now this number is in currency, so we will convert this to currency and we will remove the decimal points. Okay. Also, we had plugged in formula over here, and if we want to scale it to the next years, we will just copy this formula and paste it in the following years. So that way, we now have the outlet sale for the next 3 years. We will calculate similar numbers for the food delivery app. We don't have any numbers for current year, but we have it from year one to year three. So this is food delivery. Here also we are going to use the same revenue drivers from the above, where we have units of sandwich sold on monthly basis, we have unit sold annually, and finally we have average revenue per user. So we are going to take this from, for the current year it was all zero, as we did not do any revenue, and for the later years we will be then plugging it from the above. So on the monthly basis, we in the year when we are going to do 300 sandwich, we have, so 300 sandwiches will give us 3600 sandwich on a yearly basis, and the average revenue we can directly plug in from above. So that way we have all the three revenue drivers. We are going to copy this and paste it for the following years. To calculate the revenue from food delivery app, we are going to use the same multiplication formula that we used above. So here we are going to write this as revenue from food delivery. So in year one this is zero, as we did no revenue from food delivery app. For the year one we are going to multiply 3600 sandwiches by 135, which will give us 486, and similarly to year three we scale this up. So that way we now have revenue projections ready with us for outlet sale and for food delivery app. We are now going to calculate the total revenue that we are earning from our business in the next 3 years. So initially we did revenue from the outlet sale, and there was no revenue from food delivery app. So the revenue, total revenue is 10 lakh rupees. Similarly, we will just plug in this formula in the next years, and we now have revenue of 1686 in year one and scaling it to 42 lakh and 50,000 by year. So below total revenue we have given a metric for revenue growth, just to track how your revenue is growing once the funding is coming into the company. So the 20 lakh amount that we are raising, we are using it to expand to two outlets, and from that we are going to earn this much amount of revenue. Showcase to the investor how much is the revenue growth that we are projecting, so that this metric will definitely help us to showcase that. Current year we don't have any growth because we don't have previous year's number. For the year one we will calculate the revenue growth as current year number divided by the previous year number, make it to percentage. So here we have already plugged in the percentage part, but in default it will be in number. So if I can show you this divided by this, so this is what you will get as a number. You have to go into this and select percentage. So that way you got 168%. You can then shorten the decimals, and 169% is your revenue growth. Similarly, we will do for year two and year, and we have this growth rate 169% in year one, 150 in year two, and 169 in year. So this is the revenue growth that we will have once we have two outlets ready with us and we have expanded into NCR and Noida. So we will start plugging in the numbers from the model into this 3 years projection. So first line item is revenue from operations. We have already calculated that, and we have numbers for year one, which is 1686, and we will plug in for year three as well. So we have first line item ready with us. Next, now we will move on to projecting all the assumptions for expenses. So the first line item of expense is COGS, which is the expense for all the raw material. If you want to understand the explanation of each and every line item, you can definitely watch the first part where we saw all the line items in detail. How is it projected, what is its meaning, and how you can derive that particular line item. Would recommend going through that if you want to understand about it. So about COGS, we are projecting that in year one it will be 30% of sale, in year two it will go down to 28% of sale, and year three it will go further down to 26% of sale. Now the thought process behind reducing this COGS or COGS as a percentage of sales is, when you scale your business, you start getting economies of scale. Economies of scale means that for anything that you were selling out earlier, which used to cost you 10, now it will cost you 8 rupees because you are purchasing things on larger scale. So for our example, let's assume that we used to purchase 10 packets of bread from a vendor and he used to quote us 30 rupees for a packet of bread. Now that we are expanding our outlets, we have two more outlets. Now the requirement of bread will be much more. So instead of 10, we are ordering 30 packets of bread from him. And now he is charging, instead of 30, he is charging us rupees 27 for each packet of bread. So that is 10% reduction from initial quoted price. So that way you have economies of scale in the entire raw material as you scale your production. That is what the ideology is behind reducing this COGS over here. So vendor partnership improve gross margin as we scale. So that is true. So gross margin over here is gross profit that we will see as we project the entire 3 years. So 30%, 28 and 26. Now we will go back. So revenue is done. Now we will move to this OPEX sheet where we have COGS with us, and after COGS we will project all the operating expenses as we have template ready with us. So we will just copy paste the entire headline headers from the okay. So we have particulars current year 1, year 2, year. For the current year we have COGS of 3 lakh rupees on a 10 lakh rupees sale. So what that means is currently we have 30% COGS and the revenue was 10 lakh. Okay, so this is percentage of sales. So that way when we multiply this 10 lakh to 30%, we get 3 lakh of COGS. And since this is an expense, we are going to give this minus 30% so that we have negative 3 lakh as our COGS, which we can then take to the P&L statement. So COGS for the year 1, we saw that the COGS is 30% of sales, 28 for year 2, 26 for year 3. So we'll plug in those numbers, negative 30, negative 28 and negative 26. So we have it as a percentage of sales. Now sales is revenue. We will plug in the revenue numbers from this revenue sheet from here and we will do it for the next 2 years. And similarly, we have formula plugged in over here. We will just copy and paste this. Okay, so now we have our COGS line item with us projected for the next 3 years, and we will now take this numbers to our model. We want to keep this entire model dynamic so that when you change any of the assumption, the entire financial model automatically changes and you don't have to plug in numbers manually. So here also we have taken this from the revenue sheet. For COGS also we will take this from this OPEX sheet where this is the number for year 1 and we will then keep this for all both the years. Here I am going to use the negative number format. And okay, now we have COGS and revenue with us. Let's now calculate the gross profit, which is sum of these two. Okay, so we have 11 lakh 80,000 as gross profit for year 1. We are going to paste this in the next 2 years. Now to calculate gross profit margin, we will divide gross profit by the revenue from operations. So we are steady at 70% gross profit in year 1, and by year 3 we are increasing our gross profit to 74%. Since we are seeing more customers into our business and our outlet are stabilizing, we are then on the high trajectory of revenue and profitability. Okay, so that way we calculated the gross profit. Now let's move on to projecting all the operating expenses for the company. Let us start with the employee benefits and salary. So over here once again we will paste this entire header and let's now see the assumption for employee benefits. Okay, so employee cost assumption. Year 0 there are 2 staff. So year 0 is the current year. We have 2 employees with us who are helping in making the sandwiches and serving the customers into the outlet. In year 1 we are adding 2 more staff, so the total rises to 4. In year 2 we are adding more 3, so total will be 7. And in year 3 we are adding 1 more, which will make the total 8 by year 3. And the salary growth is assumed at 20% year on year basis. So in year 1, as we are having 1 more outlet, we will definitely need more manpower. So whenever you are creating model, make sure that the assumptions that you are giving in for employees is aligned to how you are growing your revenue, because that will help you justify your model, right? So as we are also creating a storyline around the entire financial model, we mentioned that initially we have 2 staff who are helping and making sandwiches. When we open 1 more, we add 2 more staff. So that way you have to create entire storyline around what you are building your model for. Salary rise, but so does scale. So that is true, salaries do rise, but those employees or those manpower will be helping you increase your revenue as well. So now let's model for this employee cost assumption. Coming back to sheet, now here we will mention what are these employees for. So these are outlet. We do not need any kind of staff for our food delivery app because that is entirely managed by technology, and we don't need anyone to deliver sandwiches on behalf of us. So for outlet staff, currently we have two staff. So there are full-time employees, FTE roles. So FT is full-time employee role, which we have two, and we have the amount of total salary paid to them, which was 2 lakh from the model. We can see over here. So employee benefits paid was 2 lakh, and so as we have two employees and the amount was paid 2 lakh, we can then get average salary as 1 lakh, which was being paid to both the employees. I know this amount is very much on the lower side, but this entire model is for your understanding of how you can create a storyline, how you can present your assumptions. Everything that you put in into the model should be research based, should be data backed, and you should have a detailed assumption sheet with you. So this will then become the average CTC for each and every employee, and this will then become employee benefits. Okay, so we have two employees each being paid 1 lakh as salary, and we have 2 lakh as entire employee benefits for the current year. We have two more added in year one, so our total becomes to 4. So this will be this plus 2. Three more added in year 2, so this plus 3, and one added in year. So that way we added the FT roles, and next we are going to add the CTC. So for CTC, we had salary growth at 20% year on year. Here also it is very simple. We will take this assumption, we will multiply it by 120 percentage, which will give us 1,20,000. In year two, this will, okay, so we can copy and paste this entire formula over here, and we can also got perfect. So the salary is rising from 1 lakh to 170 to 800 in year 3, and the employee benefits total then can become, okay, so this is giving me an error because I did not see that this was plugged in from PNL. This is not formula based, so I have to manually add formula over here, which will be which will be 4 multiplied by 1 lakh 20, which is 4 lakh 80, and now this formula can be pasted. Perfect. So we now have the employee benefits for the model, and we will plug this into our P&L statement. So here employee benefits, we are going to take this from OPEX sheet and paste it. So we now have the employee benefits as well. Final element of the operating expense is SG&A expenses. So now we will project SG&A for our model. So we will go back to our presentation, and so the first element of SG&A is app delivery commission. So what are we assuming over here? App revenue is equals to 30% of outlet sales in year 1, year 2, 35% in year 3. So this is what we have already projected in our revenue projection. Now the app delivery charge. So here it is mentioned that 25% commission in year 1 and year 2, and 20% commission in year 3. What is the storyline behind it? So we assume a 25% commission on app orders in initial years. With scale and better negotiation, the rate reduces to 20% in year 3. So the idea behind this is, whenever you are putting your restaurant on any of the food delivery apps, there is a marketing manager who is associated to you, and you are having direct conversations with him. So initially they will quote you a commission rate, and if you agree to it, they will add your restaurant on their application, and they will start the order delivery services. Now as you scale, you if you are having good order rates, and if your business is growing very fast and there are a lot of good ratings, the you can then negotiate a better commission rate with the application, because you are giving good revenue to them. They are happy to serve you with lower commission rates as well. So in year 3 we are expecting that we will have good customer base around us. We are going to have new outlets as well, so that way we will be able to negotiate a better commission rate, less from 25% to 20%. That is the entire ideology behind that. On the OPEX sheet now we will be projecting the SG&A and every element that goes into it. So first I'll just plug in the headers for each. Okay, so this is app delivery commission. For the first year we do not have any commission, so we are going to put 0 in all the three. So what do we have with us? So we have commission rates, and commission rate will be applied to sales that are happening on the food delivery app. So we also have the revenue that we are earning from food delivery. So first we will plug in the commission rates, which is 25% for year one. Sorry, this is zero. There is no current rate. This is 25%. This is 25%, and in year three we are negotiating a 20% deal. So to calculate the commission that we are paying to food delivery partners, we will now plug in the revenues earned from the food delivery, which we have over here. The revenue from food delivery app, we are then pasting the entire line. Okay, so we have 4 lakh 86 in year 1, 7,626 in year 2, and 1364 in year 3. We will have a cross check and perfect. Okay, so what is the commission that we are paying? Commission paid. Multiply the rate into the revenue earned and paste it across all the lines. So we are paying 121 in year 1, and that goes up to 272. So this is a commission paid, so we are going to put it as negative mark. Okay, so we have the commission rates, which was the first element of SG&A. Now let's assume the second element of SG&A, which is marketing and branding. So the assumption for this is we are outsourcing social media manager at 15,000 per month in year 1, and this amount increases 20% year on year. Okay, perfect. So over here, you have to bring in confidence to your investors that you are focusing on building a good brand and doing marketing around your business, so that you attract more customers and that your revenue will then increase from it. So keeping an element of marketing and branding in your model is going to help you negotiate better and portray a good storyline which is realistic in nature to the investor. So branding matters, and we are investing early in digital presence as well. So this is what will be portrayed to the investor's mind, that you are already starting with your branding and marketing thing on an early basis. So let's now model it. This is for marketing. It is important to understand that marketing and branding are two different elements. Marketing is something which you are attracting customers in your business by some ads or some kind of offers, discount. It is more like a push thing that you are spending money and you are gaining customer. Whereas branding is more on the pull side, where you have created a business aura around your products. When you name sandwich, it is only Sandy's sandwich. And if you create such branding around your business, that will pull customers. So branding is always pull and marketing is most of the time push. So we can keep this as particulars, and we have marketing and branding with us. Currently we did spend 20,000 in marketing, which we discussed in the previous part of this module. Okay, so this was negative 20,000, and in year one we assume that we are spending 15,000 on a monthly basis. So this will be 15,000 into 12 to get an annual number. Since 15,000 is paid, we are adding negative 15, and we got 18,000. Sorry, it's 1,80,000 as our marketing and branding charges for year one. In year two, we are growing by 20%. So this is once again 1.2, and in year three also 20%. So that way we have now branding and marketing element for our SG&A. So we now move on to the next element of SG&A, which is rent for new outlets. So here we can see that in year one we are expanding to new outlet. So for that we are having 300 square feet in NCR, and in year two, since we are expanding a second outlet, we are then renting out a 400 square feet space in Noida. The rental over here is 110 per square feet. Now, these rental rates are on a monthly basis, which you have to pay for renting out a commercial property. You have to do a good research on what is the rental rates that are going around in particular area where you are planning to expand your business. So for our case study, since the first outlet was our own, which is in Delhi, and we do not have to pay any rent for that. So here, while you are also projecting, take care that what area are you expanding into and what are the rental rates going over there. And next thing that you have to take care is what are the rate escalation. So every year there are some kind of hikes that happen in rent rates. So make sure that you are having a historical data research of what was rate rises for the that particular area and what is projected for the future years, which will help you map out the expense in the model. So for now, let us assume these rates in our model. Come to the model SG&A. So here we will plug in square feet. Then we have, so we are having zero rate zero rental in the current year since it is our own property. In year one, we are leasing out 300 square feet. In year two, we are adding more 400 square feet, which takes it to 700. And year three, it's same at 700. So, and the unit rates are 110 in year one. It goes up by 7% every year. So 7% is a conservative rate because in India the inflation ranges around 6 to 4 percentage, and 7% is assumed to be normal inflation in the rental rates around such tier one cities. So we have scaled our rates from 110 to 126. Now calculating the rent for outlets. So we now have 300 into 110, which is per month, and we are going to multiply this by 12 to get the final figure for the entire year. So 110 is negative, so we are putting negative, and we are then plugging in this for the next 2 years. So we have 396 for year one, and it's scaling up to 1057 in year three. So that way we have projected the rent for outlets, and final element for SG&A then remains is legal and professional fees. So this is also one of the, so this is the important points to consider when you are doing business with investors, because there will be a lot of legal and professional fees which you have to incur to register your business. If you are planning to expand through franchising model, you have to go through a lot of legal procedures, and every year there are some kind of accounting and auditing fees that you have to pay. When you are raising funds, you have to go through lawyers and do a lot of legal due diligences and everything. So for that you have to account some kind of projected fees and expenses in your model. For year zero, we incurred 20,000 rupees of cost, which would be of filing your annual return or your CA fees. In year one we are expecting 10,000 per month cost, which will amount to 1,20,000 on the yearly basis. And year two, year three, it increases 20 percentage over year on year. So it covers legal support, accounting and audit fees, business registration and filing. So these are some of the common costs that a business incurs. So legal and professional. Currently it was 20,000, negative 20,000. Then it is expected to rise to 10,000 per month, negative 10,000. So we have 120, and it is assumed to grow 20,000 in year two and year three. So next, finally, we have gross profit and EBITDA, which we can only calculate after plugging in all the expenses. So the total SG&A, we will sum it up, and so this, so legal fees plus rental plus marketing plus the commission to food delivery. So initially for the current year we paid 40,000, and for the year 1 to 3 we are paying 8 lakh, scaling it to 17 lakh 62,000. So we are going to plug this number into the P&L. So starting with 8 lakh, and now we have all the items ready with us to calculate the EBITDA and EBITDA margins. So to calculate EBITDA, so it is gross profit plus the employee benefits plus the SGN. So I mentioned it plus because we have taken the numbers in negative format already, and in the formulas you have to then put in plus sign instead of minus, so that you get the answer. So in year one we are having negative 1,17,000, and similarly in year two you are having 7 lakh, and in year three you are turning profitable. So let's calculate the EBITDA margins, which is EBITDA divided by the revenues, which is negative 7 to negative 29 to 0 percentage. So that is a true story that has been portrayed through this entire financial model, where once the funding comes in, most of the business go into loss because they are trying to expand the business. The revenues are not that much coming into the business. Since you are new to particular place, people will be getting to know you, and then once you get accommodated to that particular area, you will start getting more revenue. So we can see that similar story through numbers, that from 66% EBITDA margins you drop to negative 7%. In year two you are more down to negative 29%, since you are opening the second outlet and the first has still been getting customers. And from year three, since your first business grows, your second business is also getting in line. You are now able to become EBITDA positive, or we can say break even. So that is a story that your financial model portrays. To calculate depreciation, amortization, interest expense, we will need balance sheet projection, which we are going to see in the module 4 of this entire series. So we have seen the gross profit, the EBITDA walkthrough. So the learnings that we get from the model is that growth is not just equal to higher sales, it's operational clarity. So from model we saw that what are the operational things that we will need to align to expand our business. So investor wants that we grow business in a sustainable manner and that we have things ready with us. So this model will help you portray the story of what you are trying to accomplish once the money comes into the business. And investor does not just want to look at the higher sales number or higher profitability. He wants to see each and every line item of how you are going to operationally work across them. Thinking in percentage helps simplify scalable model. So that is true. As we saw that you took everything on a percentage of sales basis. We took COGS, we took gross profit margin, we saw the EBITDA margin, and that helped us understand the storyline. Like business is going to go into negative phase for the initial 2 years since we are expanding and we have a lot of expenses related to SG&A going on. And from year 3, since the first two business become stable, the revenue is at the higher rate from the previous 2 years, we will be then getting to break even. Percentage term help us to understand and simplify scalable models. And the final point is you don't need complex formulas to build great insights. So as you saw that we did not even use a single if formula or conditional formatting or anything. We just used plain numbers, good assumptions, a formatted template to create the entire financial model. So as you can see, everything is integrated with one another. A single change and the entire financial model over here will change its number. So for an example, if I increase the number of FT roles in year 4 to in year 2 to, let's assume, 10. So that way the entire financial model is changed. Now we are negative 50% to negative 24%, which was not the case. So that is the thing. The entire model is dynamic. Any change in the assumption will be impacting the forecasted P&L statement. All right, so that was the end of module 3. In these two parts, we have understood what a P&L statement is, what is its entire structure, how you can project expenses, how you can project revenue using assumptions step by step. So hope this video was valuable to your career. If you find this video valuable, do consider liking it. Share this with your friend or colleague who is interested to build career in finance and want to learn financial modeling. So see you in the next one. Until then, this is Karan Damania taking your leave.